Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent jobs report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. We did just restart the sale on ITC Premium, so if you have been waiting to sign up, now would be a great time to do so, and you can lock in a lower rate. Let's go ahead and jump in. So, there's a lot of different things to talk about as it relates to the macroverse, and of course we might touch on Bitcoin as well, but let's just go through the charts. We've also added a couple of new charts that I think people will like, so we'll talk about that as well. So the unemployment rate is now at 4.1%. Now this is still just a steady move higher. If you zoom in to the trend, it's basically just been going up by 0.1% every month since March, right? So this is, of course, the June data point, because it's July, we get the data point for June. Now, this is the unemployment rate for basically everyone older than 16 years old. If you isolate the unemployment rate to, say, just 16 to 19-year-olds, you can see that it's actually at 12.1%. But again, this is 16 to 19-year-olds. If you look at, say, 25 to 54-year-olds, the unemployment rate is only at 3.5%. But you can see that it is starting to accelerate, right? It was at 3.2% in April, then 3.3% in May, and then most recently at 3.5%. So if you were to look at, say, a year-over-year change, you can see it is in fact positive. You could look at a quarter-over-quarter change and see that it's increasingly more positive than it has been for this business cycle. So definitely a lot of interesting things happening over in the labor market. But at this point, the unemployment rate, under the context of history, is still relatively low, right? Just holding, looking at a line across the page at the unemployment rate, there have only been a few times in history when the unemployment rate was even lower than where it is now. Obviously, most of the time we spent well above a 4% unemployment rate. However, there are certain things that have still not yet triggered, like the Sahm Rule has not yet triggered. We'll talk a little about that later on in the video. Now, if we look at the unemployment level, you can see that it's moved up by 162,000 to 6.81 million. So that also is continuing to go up. And you can see that over here, it was a more stochastic move, right? Like it was going up, but it was doing so in a stochastic manner, meaning it would go up and then it would pull back, and then it would go up and then it would pull back. But ever since March, it's just been going up, right? And this is the issue, I think, for the Fed, is that this is starting to pick up some steam, and will they pivot soon enough to avoid this running away for a while, or will they not? And perhaps applying, say, like a 3-month moving average could be useful. You can see that this moved up, it then had a pretty big pullback, and then now it's just been moving up again. So I would continue to keep an eye on that. You could also look at the unemployment level by reason for unemployment. And for instance, you could look at things like job losers that actually dropped by 44,000. We could look at new entrants to the labor force. I think this is an interesting one to look at because there is a lot of evidence to suggest that layoffs, all things considered, are still relatively low. If you look at initial claims, they're still relatively low. But if you look at continued claims, they're still trending higher. What this would generally suggest to me is that people are not getting laid off as much as I think maybe a lot of people are thinking they are, but the people that are getting laid off are having a hard time finding a new job. I think one of the reasons for that is that I think over the last several years, a lot of businesses had trouble hiring talent that they had trouble finding the right person for the job and just getting talent, because a lot of other companies were sort of hoarding a lot of that talent, a lot of the big tech companies. And then now that the job market has loosened up, I think a lot of these companies are afraid sometimes to lay off a lot of people. Now, that doesn't mean that that sentiment can't change eventually, but if they're worried that they're going to be unable to find new people in a year or two that can do the job, then maybe they would rather just hold on to who they have rather than try to lay off someone and then rehire later on. So I think that this one is a really interesting metric, the new entrance to the labor market, because what this shows is it's not, it's the unemployment level going up, not because people are getting laid off, but just because there's new people entering the labor market, right? If you are now looking for a job for whatever reason, maybe you graduated college, maybe you're out of high school and you wanna get a job there, whatever the reason might be. Maybe you just wanted to take a break for a while, and then now you're back out looking for work. This shows that it is becoming very difficult, in fact, for new entrants to the labor market to actually find a job. And you can see that by the fact that this is continuing to accelerate. This is now at 708,000, but back in February 2022, it was only at 428,000. So you can definitely see it is becoming increasingly difficult for people to find a job that are new, but it is still not at, the levels that you saw back in, 2009. That was all the way, that was basically double the current value, the current levels. Um, and in 2000, it was actually pretty low, and it only started to really increase basically to the level that it is now. So I mean, it really goes to show how every metric is really interesting, and can give you insight into the market. Job leavers, how many people are actually leaving? Is that showing any useful insight? I don't see any off the bat, but again, just one more to look at. Permanent job losers. Let's just go look at it like this. Permanent job losers, unemployment level continues to slowly go up, but it's still in that stochastic process, right? It actually dropped by 121,000. So we're going to continue on. We could look at the unemployment rate per state as well, and we're just going to look at a few. We will in fact look at Alabama since it is the first alphabetically. It actually dropped slightly to 3%. I think California also dropped. It did drop a little down to 5.2%. Again, it's well off its low at about 3.8, but it did drop this most recent month. I always think it's interesting to check in on states like New York. And one of the reasons is because last time we looked at this, it was actually going down. And you can see it's leveled off again. California is always an interesting one to check in on. Actually, we just looked at California. That was the one that dropped back to 5.2%. The District of Columbia, I think, is interesting because it was actually accelerating a lot. It's up to 5.3%. And then also, I think checking in some various regions, like the Northeast, Massachusetts has been a really interesting one for me to follow, just because while a lot of states we've seen the unemployment rate just go higher, Massachusetts we've actually seen it go a lot lower, but now it's actually off its low from 2.9% back up to 3%. So, there are some states that are actually printing a lower unemployment rate like California, but then you have others like Massachusetts that actually went up slightly, but still relatively low under the context of history. We could also look at a few random ones. I think every time I'll try to just click on some random ones just in case that's where, you live and you're curious. Here's Ohio. Ohio looks like it bottomed out at around 3.3%, and it's starting to accelerate to the upside, right? In February, it's at 3.7. In March, it was at 3.8. In April, it was at 4, and then now it's at 4.2. So this one, Ohio is starting to accelerate. We could look at Texas. Texas has also been really low compared to a lot of other states. It did move up last month, but then it stayed flat at 4%. And then perhaps we will check in. I'd like to check in with the Northwest. So why don't we check in with Washington State and see what that's doing? So Washington State is up to 4.9% unemployment rate. So also continuing to slowly go higher. And then maybe one more, we'll go with the Midwest. So why don't we check in with Kansas and see what that one's doing. Here you can see it's also going up, right? It was at a low of 2.6 earlier this year. Now it's at 2.9. Now, it's interesting to sort of figure out what are the number of states where the unemployment rate is actually going up, because we saw some of them actually, have gone down recently. Most of them are going up. So we can simply go over here and say, all right, the number of states going up over the last month is 10. Well, this hasn't been updated in a month or two. But if you go, say, look at 6 months, you can see that it's currently at around 19, right, as of April. So it's currently at around 19. But again, my guess is that it's going to, it put in a high and then a higher low and then a higher high. I'm going to guess that it's going to put in a higher low and then go back up. You can see that in 2022, this sort of peaked out in Q4. And then in 2023, it peaked out in Q4. So my guess is that because the Fed hasn't lowered rates, we haven't gone back to QE, we're going to see the labor market continue to tighten up. So I would guess this is going to curl back up and then go again. And perhaps this is going to be sort of like the boy who cried wolf with some of the labor market data, right? So like the labor market was screaming, hey, look, unemployment rate's going up. And then it came back down and everyone's like, oh, it was a false signal. And then it went up again and everyone's like, oh, look at that. And then it was a false signal. And then maybe the third time is when it matters and no one's going to take it seriously. I honestly don't know. But it is something that's interesting to watch. Now, here's a really interesting chart. This is a map of states where the unemployment rate is rising over the last 6 months. Okay? When the unemployment rate starts to go up, it's sort of like a virus. It starts in certain sectors, certain regions of the country, and then it expands, right? So you can see that it's over here on the West Coast. We see the unemployment rate is a bit higher, right? 5.2, 4.2, and 4.9. But then if you go up to the Northeast, you can see you got 2.1, 2.5, 3%, 3%. Here's 4.2. Going down a little bit further, you get 4.6 and 3.4. But then you come to the Midwest and you can see that it has started to go up. Now, this is just looking at a single snapshot. What I'd like to do is play this for you so you can see what this has looked like since 1976. So that was a recession right there in the 70s, right? This is where the unemployment rate went up compared to 6 months ago. See that recession right there where they're all turning orange? That was early 1980 when Volcker finally did what needed to be done. And then that was 1981 when they basically had a double, sort of a back-to-back recession. Continuing on, we should see it turn bright orange in a minute as we get into the 1990s. We had a recession in early 1990. There it is. Okay, we're going to let it continue to play. Now we should see not a ton. There's maybe a scare in the mid 90s right there, but it didn't really affect the whole country at the same time. Now we're about to get into the dot-com crash in 3, 2, 1, and here is the dot-com crash. And there you can see the whole country was affected. Now coming up in a few seconds, we're going to get into the financial crisis. We're currently in 2006, now 2007, and here it is, the financial crisis. Okay? And then now it should be relatively boring for most of the 2000s and 10s. I think there was a scare in 2015, 2016. We're about to come up on that right here. But it didn't affect the whole country. Here's 2017, 2018. Again, not affecting the whole country. Now we're about to hit 2020. There it is. All right? And then now 2022 begins. You can see it was a scare, but not the whole country. Here's 2023, and now we're in 2024. So certain sectors of the country are weak. The labor market is weak. Other sectors are strong. But because it's not the entire country, the stock market really likes climbing the wall of worry because it needs a reason not to. And we said, until the labor market really folds, the stock market can in fact climb the wall of worry. I think this is a really interesting chart to look at it like that. It helps us visualize what's really going on, and it also shows how in examples of soft landings, you basically see it do something like this, where it never fully goes orange, like where the map doesn't fully ever go orange. But if you look at actual recessions, you see that it will, right? So right now, this is where we are, right? In 2022, we actually got pretty close, right? We got pretty close. Later this year, I think, could be sort of the high risk time as you go back and look at number of states where the unemployment rate is rising. We saw it sort of top out in Q4. What if this is the Q4 that it finally makes a difference? And then that's where the Fed ultimately has to pivot ahead of that. We can also look at alternative unemployment rate measures. This is greater than 15 weeks unemployed. We saw a big move up over the last couple of prints, right? From 1.3% all the way up to 1.5%. People not in the labor force. So this is one basically just showing you, and let's look at the year over year percentage change. It's slightly positive, right? Slightly positive, and you can see what it's done in prior recessions. Now we're going to go over to employment statistics. So there's some more boring ones like the labor force participation rate. Here's the civilian force, the civilian labor force level, and this is an interesting one to look at in terms of a year-over-year percentage change, right? So when you do have recessions, a lot of times it will go negative, but not always. There are some examples of recessions where it didn't go negative year over year. Right now, it's at 0.6% from, some highs in 2022 of over 2%. The employment level, we saw 206,000 new jobs, total non-farm, still increasing at a steady pace month over month. While it is increasing, the rate that it's increasing is steadily going down. For instance, if you were to apply a 7-month moving average to this, you can see that it was at 0.3%. Now it's at half of that, 0.15% or so. So it is starting to come down. Now, that's the establishment survey. The household survey isn't as rosy, right? While the household survey did add 116,000 new jobs, if you were to look at a year-over-year percentage change, it's almost negative, right? It's at 0.121%. And back in 2022, it was at 4.84%. So in 2022, there was a lot more excess to get rid of. Now we've gotten rid of that excess, and now we're at a very difficult level for the Fed because inflation really hasn't gotten to their target. There's no clear sign that it durably is going to do so, and therefore we run the risk of the Fed staying too tight for too long and inducing a recession. Now, there are examples of soft landings like we talked about earlier, but this is ultimately the risk that we face. Now, there's also non-farm private payroll employment level. Actually, I'm going to go back to the employment level for a minute. This is total non-farm. If you look at total private and you look at a year-over-year percentage change, it's at 1.5% on the establishment survey. Household survey, it's at 0.121. Okay. Actually, no. We're looking at the same thing. Total 16 years and older. I guess the establishment survey actually separates it out. The household does not. So there's actually a better way we can look at this. Let's first look at the non-farm private payroll employment level, year-over-year percentage change. It did get a little bit of a drop here recently, down from 1.8% to 1.49. But here we can go through some of the different categories, right? So here is construction, still steadily moving higher. Let's look at financial activities, steadily moving higher. Manufacturing, not moving higher, right? In fact, it's really leveled off here. And then professional and business services also leveled off. Now, this is one that's probably one of the more scary looking charts. This is total temporary help services. And it has been moving down essentially since the Fed started raising rates in early 2022. But it almost looks like it's starting to accelerate here. If you look at a year-over-year percentage change, you can see that it's at negative 7.7%, but it's basically been at that level for over a year now. But again, if you zoom in here, it looks like it's starting to accelerate to the downside. Right? It sort of popped up for a little bit, now it's kind of coming back down. Multiple job holders has actually decreased by about 158,000. Here's an interesting chart. This is job postings on Indeed. Sort of normalized for where it was back in pre-pandemic in February of 2020. So if you look at it like that, you can see that it's still a little bit higher than pre-pandemic. It's at 111, and then pre-pandemic is normalized at 100. So you can see that it has come down a lot, but it's not at that pre-pandemic level. This is total job postings on Indeed. Now, if you look at various sectors of it, you might see something different. For instance, if you were to look at mathematics, my undergrad was in math, actually, which is why I'm interested. If you look at mathematics, and you look at pre-pandemic 100, today it's at 77. So in some areas of the labor market, you can see a lot of this excess was already removed, but in other areas, it hasn't been removed. In marketing, it's actually below the pre-pandemic levels, and it has been for quite some time. With media and communications, it's well below the pre-pandemic levels. If you were to look at scientific research and development, it's well below the pre-pandemic levels. If we look at sports, it's above the pre-pandemic levels, right? So it kind of, and maybe we'll look at physicians and surgeons, well above the pre-pandemic levels, right? I mean, this is at 178 compared to pre-pandemic of 100 because it's normalized to that, right? Management, I wouldn't be surprised if this one's coming down, right? And it is. It is. It's near the pre-pandemic level. It's currently at 104. Now we're going to get into job openings. Now, job openings is an interesting one because it has been steadily moving down. And, you know, the headline earlier this week was that they beat expectations. That's true, but this has been a stochastic process the entire time, right? I mean, it hasn't just gone down in a straight line. And if you were to apply moving average to it, you can see that it has been generally trending down. If you apply 7-month moving average, I mean, you look at that. It's been generally trending down. At this point, though, it is still above the pre-pandemic levels. It's slightly above. But if you were to go over to the workbench and look at job openings per unemployment level, it is still above the pre-pandemic highs or pre-pandemic sort of lows right there, but it's actually at the pre-pandemic high of around 1.2. It's currently at 1.22. So a lot of the excess that all the money printing created back in 2020, 2021 in terms of job openings per unemployment level, that's been removed. Now the question is, does the Fed cut rates before this really starts to get below the pre-pandemic levels? And I don't know the answer to that question, but that is ultimately the risk that we face. So we can continue on, and we can look at, so here's job openings. And I wanted to go through a few different categories. So manufacturing job openings actually saw a big increase from 488,000 up to 603,000. Retail trade, though, continues to drop. I mean, retail trade is basically at the lows of 2020, which is kind of crazy to think about, honestly. Construction job openings. Been moving down a little bit, but not too bad compared to the context of history. Government job openings went up a lot. And then that, I think, is the main reason that we saw job openings beat is because, I mean, look at this. I mean, government job openings went from 906,000 to 1.08 million. So a lot of the job openings that you're seeing are actually coming from the government. You can also see it in state and local as well, right? Big move up in state and local job openings from 767,000 up to 909,000. Now, if we look at job quits, you can see that it increased slightly. Generally speaking, during slowdowns in the economy, you would expect this to drop because fewer people are going to quit their job if they're afraid of that they're not going to be able to find a new one. And you can sort of look at this in terms of the job quits rate and see it's basically been flat, since late 2023. It hasn't really moved a whole lot. Initial claims. This is the one that shows that layoffs aren't really as high as you might expect. They are starting to move up here, but they also moved up around this time last year, right? Into those summer months, we saw it move up. So I don't know if it's seasonality. I don't know if it's going to be something else. But initial claims are still relatively low under the context of history, right? I mean, if you're talking about something recessionary, you would expect more so in the 300,000 range, not still in the low to mid 200,000 range. Here we have initial claims per state. This is non-seasonally adjusted, so there is quite a bit of noise. I do find some interest in looking at a few of the states, like Nevada is an interesting one to look at least for me, and then also California. You can sort of see these subtle higher lows, but also they've been putting in lower highs. So we'll see which way it breaks. Here's an initial claims map, normalized by population. So this way, the last time I showed you this chart, I don't believe it was normalized by population. Now it's actually normalized by population, so you can see where the layoffs are actually occurring the most when normalized by population. You can see that it's mostly out west, and then some up here in say like Pennsylvania, New Jersey, and Vermont, Massachusetts. So the Massachusetts unemployment rate is low, but when you normalize by population, there are some initial claims coming in that are pretty high, suggesting that we might start to see the unemployment rate tick up in those states. If you look at the number of states where, say, there's a 30% rise in initial claims over the last year, it's currently at only 6, relatively low. Now, if you change that to only 10%, it's at 19. Here's a map of the states where the initial claims is rising by about 30% year over year. It's only about, 7 states right now. Not very many states. Now, if you scroll this back to 2023, late 2023, I mean, you can see that it did start to turn orange, but then it got back to normal. Now, again, it's just a slow process, but there's nothing, when you look at this, it certainly does not look like what you saw during the financial crisis or, the dot-com crash, right? It's still relatively muted at this point. Now, continue claims, that's the one that while initial claims haven't really moved that much higher, continue claims are still, they never really went down, and they moved up a lot last year and the year before that. Maybe not as much the year before that, a little bit, but they're starting to move up again. And this is suggesting that it's getting harder and harder for people to find a new job if they don't have a job. If they do get laid off for some reason, those people are having a harder and harder time finding a job. Here's continued claims per state. Again, pretty low levels that we were starting at in 2020. This is the one I thought it was interesting to look at, Nevada, not initial claims. Right? Like normally during normal economic expansion times, you would expect this to put in lower highs and lower lows like we saw back over here. But really, ever since 2022, it's been putting in higher highs and higher lows. Kind of similar thing you saw leading up to the financial crisis and the dot-com crash, right? Where it was putting in higher highs and higher lows. And you can see this was taking place for a long time, right? And then finally, the market cared. And then maybe we'll also look at California. Also, you're seeing, look at a normal economic expansion time. Lower highs and lower lows in continued claims in California. Look at what we've been doing since 2022. Higher lows and higher highs. Look at what was going on back in 2005, 2006, 2007, right? Higher highs and higher lows. And in the dot-com crash, higher, and then also in the late 1980s, early 1990s. That's the thing. The labor market is loosening up. It's anyone's guess as to when the market's going to actually care. One interesting thing I've seen a lot of people talk about is that, there's been this divergence of Bitcoin in the stock market. And I know, my views of comparing this cycle to 2019 have been met with a lot of criticism. But do remember that it was, in fact, in 2019 when we saw the exact same thing happen, right? So overlay the S&P with Bitcoin, and you will see here in 2019, Bitcoin started to go down, but the stock market still went up for a while, right? So we have seen this before. It's not like this is that unordinary. It's not like it's that crazy to see the divergence. We've seen this divergence before. Sometimes you might even think of crypto as sort of it's giving a warning sign to the stock market, but the stock market has a much longer lag associated with it. And maybe the stock market has a longer lag because there's all this money that's just going into it passively into 401ks where you don't have, look, I know a lot of us in the Cryptoverse are, eat, breathe Bitcoin, right? And a lot of you guys, I'm sure, have automatic DCA set up. Now imagine that, but the whole country is sort of doing this passive thing with 401ks. I think that's the reason why crypto might be a leading indicator. It shows the weakness there before it's realized in the stock market. Last cycle, it took 9 months for it to play out. And so far, Bitcoin had a local top in March. So you have April, May, June, July, only about 4 months in. In fact, if it were to take the same amount of time as it did last cycle, which is probably a dubious thing to even think about considering the last cycle we had a recession induced by a pandemic. But if it were, it would mean not playing out until Q4 of this year, right around the time that the unemployment rate might start to top out in terms of the some of those metrics we were looking at earlier. And maybe not the unemployment rate topping out, but some of the metrics reaching extremes in terms of the rate of change. Now, if we go back, here's a continued claims map normalized by population, also showing you California, Minnesota. I mean, in California, 1% of the almost 0.98% of the population continued claims. Now look at Texas. It's 0.5%. Look at North Dakota, 0.25%. Washington, 0.75%. Gives you an idea of where if you have a friend in California and they're saying the job market is awful, and then you have a friend in Massachusetts and they're saying, I don't know what they're talking about, they're wrong. They're both right. It's just they're right for where they live. If you're in North Dakota, you're probably experiencing something completely different than someone who lives in Texas or California or New York, right? If you're in Maine, why are you thinking that the job market's going to be the same in Oregon or in South Carolina or in Kansas, right? And if you're not in the United States, if you're in Europe or Asia, I mean the Europe labor market has been even weaker than the United States, right? So everything that you're looking at on the United States stuff, it's probably worse in Europe. The US economy is a beast over long periods of time. It really is. And, they say don't bet against the US over long. I mean, I think that's true, right? You don't want to bet against the US over a long period of time. That doesn't mean the US can't occasionally have recessions, right? But over the long haul, I don't think it makes sense to bet against the United States. Number of states where the percentage year-over-year continued claims is rising. This is one that we saw go up a lot late last year into October. What was interesting about October? That was exactly when the 10-year yield topped out, right? And the 10-year yield has actually topped out in October of the last 2 years, right? If you look at October of 2022, the 10-year yield topped, and then October of 2023, the 10-year yield topped. So what happens if we see the same thing in 2024? We will, in fact, find out. And here's the map of the number of states where the continued claims is 30% or more. So again, not all that concerning at the current time, based on what you would know a recession would theoretically look like. Hires. This was one that continues to drop, although this month it actually went up slightly. But normally in slowdowns in the economy, you can see that new hires really slow down a lot because people just aren't going to take on the risk as many workers if they're afraid they're going to have to even lay people off. But you can also look in manufacturing hires and see that it's been in a downtrend. Non-durable goods, downtrend. Retail trade, downtrend, right? I mean, again, it just, does the Fed pivot soon enough? And who knows? Who knows? No. We have some other things. Here's the Kansas City Fed Labor Market Conditions Index. Slowly going down. Not negative yet, though. Not negative. Here's the Kansas City Fed Labor Market Conditions Index. Slightly negative. Right? Well, no, it's not. It's not negative. It's at 0.1. It's slightly positive. Now, I want to take a look at the Sahm Rule. Sahm Rule recession indicator. Now, I believe in order for it to have triggered this month, it would have had to have come in at like 4.4% or something. The reason is because it's basing its reference point on a 3-month moving average over the last 12 months. Now, if you go look at the unemployment rate and you go back 12 months, right? So it's currently, we just got the data point. I guess it actually hasn't come in on TradingView, but suppose that it had, and suppose we're out in May, or we're getting the data point for June, go back to June of 2023, and you can see that it was already off its lows. Now apply a moving average, right? Apply a 3-month moving average to it, which is what it uses. And here you can see that the low for the 3-month SMA of the unemployment rate was 3.5%. But because now we're past that, we're more than a year out from that, our reference point is going to be June of 2023, which was at 3.56%. So that's why it's going to be harder for the, I think there's a good chance the Sahm Rule will trigger, but it's going to be harder for it to trigger because now the reference point is going up. For a long time, the reference point was just kind of going down or sideways. Now the reference point is going up. It doesn't mean it can't trigger. It just means you have to have a big number to really cause it to trigger. And when we get the next data point, we're going to be comparing it to 3.6% as opposed to, 3.56 or 3.57, whatever, right? So when you look at the Sahm Rule, it's getting pretty close, right? 0.5% is the trigger. It's at 0.43. It's getting pretty close, but it's not there yet. Now, the Sahm Rule was not developed at the state level, but we actually do have it at the state level on the website, right? In Alabama, you can see that it is triggered. In Arizona, you can see that it has not triggered. Well, it did, but then now it hasn't again. It's untriggered, right? California, it triggered. District of Delaware, not triggered yet. District of Columbia has not yet triggered. If someone mentions something about Bitcoin dominance going down today, I'm going to get triggered. Kansas, not yet triggered, right? So some states, we see the Sahm Rule has triggered. Some states it has not. The number of states where the Sahm Rule has triggered is at on 21. Here's a map of where the Sahm Rule has triggered, right? 21 states, right? 21 states. Here's the Coincident Economic Activity Index. I like to look at the year-over-year percentage change, still positive, 2.81%. We've gone on a long time. Those are my views. Those aren't even my views. That's just the market, right? That's just the data. That's just all I did was report to you the data. And I don't take it out with me, take it out with the data. Some states, things are bad. Some states, things are good. In order to really have a full-blown recession, you'd have to see that virus in the labor market expand to all sectors or most sectors of the country. We haven't yet seen that yet. But again, a lot of this goes back to, to risk assets and obviously there's Bitcoin and the altcoin market. But this, for Bitcoin, this is now a lower low, right? And this is something that, we really should pay some attention to. Because in 2019, this is what we saw happen, right? We saw this same idea of putting in these slightly lower highs and sort of putting these slightly lower lows. I guess there was a low here and it held that for a while. But then eventually, we saw the floor fall out and we took out this low and came to the bottom. We got to pop back up and then we came back down and put in a lower low before getting another move higher. So, when you look at this sort of chart, yes, I mean, theoretically you could draw it out like this. And yes, maybe we get some form of a bounce or so. It looks like we already went to 53K. But look, guys, at the end of the day, my views on Bitcoin have always been that we go up long enough to wreck the bears, and then we go down long enough to wreck the bulls. And when you see that happen, while Bitcoin is still well off its lows, the altcoin market is not. And that is the issue that I've been talking about for a long time. If you were to look at total 3, look at this, right? Look at total 3 compared to Bitcoin. And this is the issue for altcoins, is that they're not even that, they didn't really get that much of a rally off their low compared to Bitcoin. And that's how in 2020, when we did get a recession, altcoins actually put in a new low. Yes, it was induced by a pandemic, but the reason for it isn't so important to me. It's just, if you have a recession, then alts usually, you would probably see alts put in a new low. If you have a soft landing, then they might just put in a higher low. Bitcoin has a lot more flexibility. It is well off of its low, right? So it's got a lot more wiggle room than the altcoin market does. And also, as it relates to alt Bitcoin pairs, right? If you look at alt Bitcoin pairs, they are slowly starting to break down, right? Slowly. Not that different from 2019. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We've got a lot of great charts on the website, not only for Bitcoin, but also for the altcoin market too. I do think that, I know a lot of people call me a Bitcoin maxi. I do think that Bitcoin sort of exists outside of the altcoin market. It's kind of you should almost treat it as a different asset class. But I also think the altcoin market it can be a great way to grow your wealth if done responsibly. I just think that, when you're in a Bitcoin dominance multi-year rally, why not just stick mostly with Bitcoin and let the altcoin market work its way out while people sort of argue about which ones are holding up the best. But that's where we stand. Others Bitcoin also, in fact, looks a lot like 2019, putting in one low after another. And you can see that ultimately it came down and bottomed out in August of 2019, but it didn't bottom until after the Fed cut rates, not before. If you guys like the content, make sure you subscribe, give it a thumbs up. Again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. As I was mentioning, tons of different charts. Check those out. Crypto charts, macro charts, equity charts. We do have the sale running. Lock in the low rate. I will see you guys next time. Bye.